As I want to weigh the good economic news, which is absolutely undeniable, with the growing inflation threat and the gold rally today. How do you see this? I'm looking for, realism and sober looking at the stock market. I'm not turning against the market. I just want to know how this is going to play out.
Well, I think you need to look at the global picture first. So I think what you see currently, Larry, is you see inflation really starting to have its effects on both emerging markets and bond markets. This, in effect, is getting fund flows certainly into the U.S. side of equities. Now, a lot of people can confuse fund flows with fundamentals, but I think when you look at global growth slowing and inflation accelerating in the face of a dollar being completely devalued and debauched, which we've obviously tried both in the middle of 2008 and again at the end of last year, I think that you have an inflation problem that people obviously see, but they don't see it in U.S. equities yet.
All right, Don Luskin, you heard the dark side from Keith McCullough. What's your reaction?
Look, you listen to Ben Bernanke. What he tells you is that we need more inflation, not less. Inflation at this point in the United States is not a threat. It is a blessing. It is a reality that the Consumer Price Index peaked in July 2008, the same month that oil was at 147. And it wasn't until about 2 months ago that we even got slightly above that level. That means for 2.5 years, we have been in definitional deflation in this country. Japan's been doing it for 12.5 years. Anybody up for another 10? I don't want to go there. Inflation is your friend. Someday, if it gets too big, it can become your enemy. That's next year's problem. QE1 worked, QE2 worked. We're getting the inflation we need to get the economy back on its feet. Just be happy, worry about something else.
But Don Luskin, let me follow up on that. You have spent your distinguished career as a hard money, gold-backed dollar inflation hawk. If you're talking about significantly higher inflation next year, we're coming to the end of February this year. Stocks tend to look ahead. Why aren't you more concerned about that? Why shouldn't investors who have played this great rally for 2 years be concerned?
I don't think that it's a certainty that there will be significant inflation next year. There will be higher inflation next year, but we've just come out of a terrible deflation, and it could take many years for an inflation level that you would really want to use the word significant for to take hold and become intractable. And I think what the markets are doing is giving Ben Bernanke, who's really done a darn good job, credit in advance for being able to stuff the genie back in the bottle inflation-wise before it gets out and runs riot. Now, we all know that's a very difficult thing to do. Very, very tough. Once that genie starts to come out, he tends to want to come all the way out. It's a problem. That's just not a problem for this year, and right now we're giving Bernanke credit for next year. That's just got to be a bridge we'll jump off when we come to it.
All right, Dr. Bob Froelich, it is undeniable that profits are very strong, and it is equally undeniable that the economic news comes in high. The Philadelphia Fed report today, very strong. That comes on top of the ISMs and a spate of other data. Let me ask you this. I know you're a bull. I know you're a bull. Where are the glitches in your own bullish forecast? I'm putting you on the spot. I want you to be realistic here. Where are the Dr. Bob Froelich glitches in this humongous market rally?
Oh, okay, well, the only thing that stops the market from going to 14,000 by the end of this year would be one of two things. If we, for some reason, get some disruption in oil and we see oil back up and testing its all-time high, so oil at $130, $140 a barrel, I think that crushes business confidence and consumer confidence. That could really be a problem for the market. The second thing that would concern me, Larry, that would make my bullishness change is if Congress decides to take it into their own hands to fix the unemployment problem by putting tariffs up against other countries that we don't embrace free trade. That will be a problem because we need the rest of the world more than the rest of the world lives us. So those would be the two things that keep me up at night. I'm worried about runaway oil prices. I'm worried about Congress trying to fix unemployment. But if we can dodge those bullets, I'll see you at 14,000.
Well, all right, Keith McCullough, see you at 14,000. Let's go to Congress for just a moment. There's a budget out there from President Obama that has virtually no spending cuts and $1.5 trillion worth of tax hikes. Now, does that not have any impact on future stocks?
Yeah, of course it does. I mean, the deficit is a disaster. It's an unequivocal disaster, and that's why the dollar looks like a disaster, and that's why inflation is perking up globally, because assets are priced in dollars. Now, to take a step forward and look at what could concern Dr. Froelich going forward should be certainly what should have concerned him in the first quarter of 2008 when he was calling for 14,000 then, which is the degradation of corporate profit margins. And in Q4 of 2007, that was the rollover in corporate profit margins, Larry, and it came from inflation, and you just saw it come right back into corporate profit margins in the fourth quarter of this past year.
But Don Luskin told me a few moments ago that we shouldn't worry about inflation, and that, in fact, it may be out there in next year, but not to fret about that. So how does that work into your scenario?
Well, inflation, for me, is a policy, first of all. So it's there. I think on a reported basis, the U.S. government's obviously going to tell you about their cockamamie core inflation calculation that they've changed 9 times since 1996. But when you look at inflation, it's priced in the bond market. It's definitely priced in emerging markets. And when you have to look forward, these corporate margins are definitely, as you said, the mother's milk of S&P earnings expectations. And I think Don would also admit that that's what really drives his bullish outlook.
All right, Don Luskin, higher inflation and lower profit margins. How do you react to that?
Well, stocks aren't priced off margins. They're priced off earnings. Earnings are just 5% to all-time highs. We're going to get forward earnings at all-time highs within the next few months, essentially no matter what happens. It's just baked in the cake. And when we do, there's really no good reason why we shouldn't be at all-time high stock prices. Earnings are nominal. Don't forget that. So if you get a truly definitional inflation, which is just a rising price level in all things, just imagine you just add a zero at everything in the economy. That would be perfect inflation, right? Well, you just add a zero to earnings, too. So that just isn't going to be our problem. Besides, it just doesn't matter. We are not going to have breakaway inflation anytime in 2011. We're going to be worrying about this in 2012, 2013. Markets are forward-looking. They're not that forward-looking. Don't let the perfect be the enemy of the good. You want to be in this market, and don't tell yourself these what-if stories about what could happen 2 and 3 and 4 years out that would cause you to continue to miss this rally if you haven't been in it since July 2nd of last year. 31% up, guys. And the bears, like Keith, have been telling the same stories, keeping themselves out of the market for 31% since last July. It's a gigantic mistake. How long do we have to repeat it?
Keith McCullough, have you missed 31%?
Well, again, I don't have to start from the base that Don started with. Remember, he was fully invested in 2008, and so was Bob.
Keith, just go to your own website. Everybody go to Keith's website, and you will see that you got completely out of stocks right at the bottom in July 2007. 0% stocks right at the bottom.
All right, I think we just got a sore spot.